This is the first in a series of um, kind of a review of the basic accounting theory. This kind of works with finance classes. It also is very helpful if you're an accounting major. Either way, it's really helpful. You know, as I have degrees in accounting, economics, and finance, I try to bring it all together, and I teach statistics. I try to get it all together and present it in one format. So I've created this fictional company, Tom's River Corp, and there'll be 3 or 4 parts to this series because I want to start with the income statement. Then we'll do the balance sheet, retained earnings, statement of cash flows, and an overview. But if we look at, let's focus, and this is an interactive spreadsheet, and that's why I created it, because by using it, you get an idea of how how these statements should actually flow. So we see that on the income statement, and every company has an income statement, whether it's a small mom and pop business or it's the Coca-Cola Corporation or the International Business Machines Corporation. Either way, you are going to see an income statement. We'll get into the balance sheet in the next video. But here we have sales of, well, it's all in thousands, and you always want to watch out for that too when you're studying. So this is in thousands. So the sales for this company would be approximately $3,074,000. And if we take out the cost of goods sold, and watch up here, because that's, for those of you who have a good knowledge of Excel, you'll appreciate this. And if you don't, it's a chance for you to start to begin learning Excel. The cost of goods sold in this issue is $2,088,000. So when you subtract what it costs, the raw materials to create these sales, and this is obviously something like a manufacturing company. Service companies, finance companies are going to look a little different. And obviously that's why you have to keep studying to learn the different nuances. But at the end of the day, it all looks the same. So gross profits are $986,000, and notice up here, I subtracted sales from cost of goods sold. Now we take out our operating expenses. So selling expenses would basically be commissions, what you pay salespeople. Maybe you outsourced your sales. However that worked, the accountant would plug this into selling expense. Administrative expenses would obviously be legal, accounting, overall administration of the firm. And the reason why we break these out is we want to see what our profit margin is versus what our raw material cost is. And not just, and we're going to learn this in further videos, when we look at ratio analysis, we don't just compare our cost of goods sold on an absolute basis. We look at it relative to other companies within the industry. So for instance, in some industries, cost of goods sold might naturally be very high, and the company makes money on financing or different things. Here, in this particular industry, and we just made up this industry, we hope that this ratio of 986 to 3074 is commensurate with the other companies within the industry and makes sense for that industry. And if it changes or varies by much, we're going to want to ask that question. So these numbers kind of are a clue to where you start asking questions. Another expense might be the leases that we have on automobiles, on different copiers, things like that. And then a very important number is depreciation, which I'm going to spend some time in a different video on depreciation because it's such an important part of of understanding finance. But basically and quickly, the government urges us to start businesses and create businesses because when we create businesses, we create work, we increase the GDP, and we have more people who are out in the workforce paying taxes. And that's going to be another video. But what happens is when you build a building, when you do anything of a capital expenditure, a building, a truck, anything you buy, the government allows you to write it down against your earnings. So it becomes a non-cash expense because you've already spent the money, but you're able to deduct it from your earnings so you pay less taxes. So again, this is a video for another time, but to some, it's like your mortgage. You don't actually pay the entire mortgage. You're paying the mortgage less the amount you deduct from your taxes. So depreciation is a way for the government to encourage us to invest in different things. So we get to deduct it from our taxes, and that becomes part of our expenses. And notice that our operating profits are now going to be the gross profits minus the operating expenses. So we have operating profits of 418, which was reduced by the depreciation. So then we take out our interest expense, and then we have our profit before taxes. And again, if you look up here, you'll see that helpful formula for how I did the Excel. So now the taxes actually come out of, the taxes, in this case, I just plugged in a number because I didn't use a percentage, but they're a percentage of our net profit pre-tax. And if you do 924 divided by 325, you're going to get that number. But notice that tax number, the pre-tax number, the number we generate, the number that generates our tax liability is inclusive of this depreciation number. So you see how if we didn't have depreciation, this number would be higher and we would pay more taxes. So the government is effectively picking up, if you do the math, and again, I can't say this enough, we'll do this in another video, the government is effectively picking up our tax rate because they're reducing our taxes. So afterwards, and we're the government, net profit post-tax will come out of these two numbers. And then any dividends we have to pay, preferred dividends, which is another subject. What a preferred stock is, it's basically debt. You know, it's not really equity. It comes on the equity side of the sheet and it helps banks and firms that need to show more equity. But at the end of the day, it's debt. It's like a debt. It's like a perpetual debt, but it is preferred. So we have to pay that dividend, and then that's the earnings that are available for our shareholders. In this case, we have 76,262,000 shares outstanding. And when you divide your earnings by your shares outstanding, you get that all-important EPS number. Again, another important metric. EPS is the way we could look at how much our shares are earning. For instance, if this stock was a $29 stock, our EPS would be earning 10% of the our earnings would be, our stock would be generating 10% of its value in earnings. And that would be our return on equity, so to speak. But there's more to that, and that's got to be another. This is more of an accounting treatise, but there's going to be more that I'm going to do in terms of EPS. That's important for me to explain to you. I'm going to put this under the Finance Academy, and I'm going to create an Accounting Academy, so you have both for my students, okay? I'm just writing it down, so remember to do that. And then finally, we have the dividends we pay, which is, you know, the board of directors and the chairman decide how much they want to pay. And it's a function of what they think they're, you know, again, the clientele effect, what kind of what our shareholders are expecting, what's reasonable for our industry, what's reasonable for the market, and that's our dividends per share. So if you look at this balance sheet again, and if you send me an email, and if you're in the comments, if you're one of my students, and you send me an email, and you know, in terms of requesting in the comments, I will send you a copy of this spreadsheet. I have no problem doing that. I would like to do it, but I need to know, you know, who needs it. And anybody who really wants to see it, just give me a place where I can send you you know, give me your email, and I will send you these in the comment box, and I will send you this interactive financial statement Excel spreadsheet. But that's basically it. You know, go through this again, watch my video, and we will do the rest of these, which is the balance sheet, and then the retained earnings, and then the short-term cash flow. We'll also be talking about earnings per share and price earnings ratios, and eventually we'll be doing videos on financial ratios. So this helps in finance, no question. You need to know this. It's a prerequisite for finance classes, and also definitely if you're studying accounting. And they kind of go together. All right, so it's always a pleasure, and you'll be hearing from me again.